Welcome back to Plan Life Right. I'm Kevin Ross.
I'm Matt Floyd.
Matt, you got a phone call last week you have to tell everyone about.
So an old colleague of mine, we worked the same branch back in my old banking days. Good guy. He just turned 66. He retired in the spring. He calls me up and he is fired up.
Good news, I take it.
He goes, Matt, did you hear? They made Social Security tax-free. I don't pay a dime on it anymore. And before I can even respond, he tells me he's about to pull a big chunk out of his IRA to finally buy that RV he's been dreaming of for about 30 years.
Because in his head, the tax problem just disappeared, right?
Yeah, that's how it always works, right? Taxes just go away. That headline told him the coast was all clear, so now he's ready to floor it.
Here's the thing, he's not wrong. That something has really changed, but what he thinks changed is not what actually changed.
Yep.
And that gap, the gap between the headline and the tax code, that gap could cost him thousands of dollars.
And he is not the only person who read it that way, and not by a long shot.
Yeah, not even close. So today, we do one thing, we separate the headline from the rule. So let's go. This is Plan Life Right, the show where we make sure the income you work for your whole life actually shows up. So on time and after taxes.
And this one kicks off a 3-part series because there is way too much here to cram into one sitting and do it right.
Right. So part 1, today is the myth. Did Social Security actually become tax-free? And then part 2, we build the formula that decides what you owe line by line and on the board. And then part 3, the 5 things you can actually do about it. And I want to promise you something up front. We're not going to hand you a headline and a feeling. By the end of these 3, you're going to be able to look at your own retirement income and know, not guess, whether the IRS is in your Social Security check or not.
Which almost nobody can even do right now. Ask 10 retirees how their benefit gets taxed. You'll get 10 shrugs. And maybe one guy who's confidently wrong.
Yeah, right. That's that engineer on a spreadsheet. And that guy usually has an RV, though.
Exactly, yeah. That guy always has an RV. So before anybody buys one, let's start with what everybody thinks they heard.
Hope we don't have an RV as a sponsor.
No, I don't think so. Yeah.
Campers World.
Lazy Days RV out there.
Yeah. All right. So the headline, and you saw a version of it everywhere, was basically seniors won't pay taxes on Social Security anymore.
And I want to be fair to the politics here because people feel strongly on both sides of it. We're not doing that today.
Correct. Doesn't matter who you voted for. The tax code doesn't care. Neither do we. We only care about what the rule actually is, yes?
Yeah, so, Kevin, what does it actually say? Because, my buddy is dead certain it says tax-free.
Okay, so what actually passed was a new deduction, a deduction for people 65 and older. And look, a deduction is a real thing, right? It can lower your tax bill, sometimes all the way to zero. But a deduction is not the same as taking Social Security out of the tax equation.
Okay, but be honest with me. For some people, isn't that a distinction without a difference? If the deduction wipes out their tax, who cares what it's technically called?
Yeah, it's. I think that's a fair shot. And I'll give you a part of it. For a lot of lower income retirees, you're right. The practical effect is close to, I owe nothing. Mm-hmm. I'm not going to pretend, otherwise here.
So then why are we making a whole episode out of just the wording?
Because the deduction has a front door and a back door.
Oh, God.
That's an age requirement, and there's an income requirement. You cross either one of those lines, and the thing you were counting on shrinks or maybe even vanishes.
The age one gets people immediately, doesn't it? Because plenty of folks claim Social Security before 65. That's a huge no-no. Please go find our episode about that and watch it and then watch it again. But yeah, most people are taking that Social Security before 65.
Yeah. And, that's a huge point. You can start Social Security at 62. Millions of people do exactly that. If you're 62, 63, 64, and collecting a check, this new deduction, guess what? Not for you. Not yet.
Yeah. So the exact people who claimed early, who are often the ones who needed the income the soonest, they're the group this headline quietly skipped.
Yeah, that headline said seniors. The rule said 65 and older. Those are not the same group of people, and nobody put an asterisk on the headline.
And here's a wrinkle. A lot of people at 65, 66, they're still working, especially in today's economy. They're part-time, or maybe they're doing consulting, maybe a little business on the side, or they're wrapping up their book of business, or they have an earn out from selling a business or something. I mean, does that mess with any of this?
It can, and this is where it gets real, because your income determines the size of the deduction. And if you're still earning, that's income. So the person picturing themselves as a fully retired and the person still pulling a paycheck at 66 can be treated very differently, even at the exact same age.
So I'm 65 is the ticket in the door. What's my income decides how much of the deduction actually survives.
All right, you got it. The age is the eligibility. Income is the size. And those are two separate gates.
Yeah, and one more practical thing, because people ask us this constantly, is where does this even show up? I mean, is it automatic, or do I have to go claim it somewhere?
Yeah, that's good, because you don't want to leave it sitting on the table. So for 2025, it lives on a new form, Schedule 1A. Your preparer or your software should pick it up. But look at the return and make sure it's there. And here's the genius plan. I don't want you to skip it. You get this whether you take the standard deduction or you itemize it.
Yeah, that's actually rare. Usually you're picking one lane or the other.
Yeah, you're right. This is the one you get either way, okay? So even if a retiree who takes the standard deduction, which is what most retirees do, still gets stacked. You still get stacked this on top. That part's the real gift. You just need to know who it's for and how long it lasts before you rearrange it.
So step one is just don't assume the headline is talking about you. It might not be.
Yeah, exactly. So step one is figure out if you're even in the room before you start celebrating. Okay, so now let's put the real thing on the table, because I don't want anyone thinking that we're dismissing it. This is a genuine tax break, and it's worth real money.
Yeah. I mean, give me the numbers, though. I mean, what is it exactly?
Yeah. So for tax years 25 through 28, if you're 65 or older, you can deduct a $6,000 per person, married, and both of you are 65 plus. That's up to $12,000 on a joint return. So you both got to be over that number,
right,
to get the $12,000.
And that's per person. So both spouses qualifying is that sweet spot.
Both spouses, 65 plus, filing jointly, $12,000, and it stacks. It sits on top of the extra standard deductions that seniors already get. So this is separate, and it's an additional line.
Yeah. So let's talk a little bit more about that, because I think people are going to, they're going to conflate the two. There's already an extra deduction just for being 65, right? This new thing, it isn't replacing it.
Yeah, correct. And people get they get this wrong constantly. There's a long-standing extra standard deduction for being 65 plus, a couple $1,000s a person, and it nudges it up a little each year. The new $6,000 does not replace it. It sets on top of it.
So a single retiree over 65 is stacking the regular standard deduction plus the old age 65 add-on plus this new $6,000.
Yep. 3 layers. And for the right income level, the total a senior can shelter got a lot bigger than that one headline number makes it sound.
So put a number on a lot bigger for me, ballpark, single retiree over 65.
All right. So let me simplify around it. A single filer, 65 plus, is looking at the base standard deduction, call it around $16,000, plus the age add-on of roughly $2,000, plus now the new $6,000. So you're north of $24,000 in deductions, before you've done a single clever thing.
So the first 24-ish thousand of income is essentially shielded.
Yep. So for that filer, roughly, yes, and that's exactly how a modest income retiree ends up owing nothing. So it's not magic, it's stacked deductions, which is why for a lot of those folks, that tax genuinely does go to zero. So I keep saying it because it's the true part of the headline.
All right, that makes some people really do hit zero part actually land. It is real.
Yeah, it's real. It's just not universal. And it's not, unfortunately, forever.
Wait, hang on. You said filing jointly earlier. What about the couples who file married but separate?
Oh, boy, we got to go there now. They're not eligible. If you're married and you file separately, you don't get the full stop.
That's going to catch some people who file separately for other reasons and never see it coming. And do you actually have to be collecting Social Security to claim it?
No, and that's the part that surprises everybody. You don't have to be drawing a benefit at all. You just have to be 65 by the end of the tax year. It's tied to your age, not your check. I know it's jacked up.
I mean, but the people that have watched the episode about claiming Social Security at 70, they're sitting real pretty because they're not even taking their Social Security and they're getting this deduction for 5 years before they even turn the faucet on.
Yeah.
Man, you guys should listen to us. I'm telling you.
Sometimes we come up with good stuff.
I know, right? I mean, so far this genuinely sounds good. So where's the catch? There is always a catch, especially with taxes in the government. They have always got a catch somewhere in there.
So here's the catch. It's the income.
Okay.
This deduction phases out. So once your income climbs above or over $75,000 as a single filer or $150,000 for a couple, guess what? Starts shrinking.
But how fast is it shrinking?
Okay, here's the 6 cents on every dollar over the line. And it doesn't just shrink. Eventually, it's gone completely. So fully phased out at $175,000 for a single filer, $250,000 for a couple.
And if only there was a way you could have tax-free income during retirement that doesn't count as income and doesn't show up on a balance sheet.
Podcast on tax
I know, right?
Income, huh? Maybe we'll do another.
Give me a real example. Somebody sitting right in that phase out. What does it actually look like?
Simplified example: single filer income at $130,000. They're $55,000 over the $75,000 line. 6% of that $55,000 is $3,300. So their $6,000 deduction gets cut by $3,300. They're left with about $2,700. So they still get some.
So they didn't lose it, but they lost more than half of it, and that's just for being at that income level.
Yeah, they made too much money. And notice what's sneaky about all of that. Every extra dollar income in that band is doing two things at once. It's taxable itself, and it's quietly eating your deduction. You feel it twice, and you might never see it the second one.
I know. Everybody loves paying taxes twice.
They're awful.
That's a theme today, isn't it? $1, 2 hits.
Yeah, right?
Yeah.
I think it's the entire theme of this series. Hold on to it because it comes back hard at the end.
Oh, no. And when you say income, for that 75,000 line, income meanings exactly what? Just wages or, everything? What's included in that?
Yeah, for almost everybody, it's essentially your adjusted gross income, that number near the bottom of the first page of your return. There's a technical version with a couple of add backs, but most retirees don't have. So the practical purposes is it's your AGI. IRA withdrawals, pension capital gains, the taxable part of your Social Security, they all feed that number.
So the taxable part of your Social Security, it helps push you toward losing the deduction that was supposed to help you with your Social Security.
Yeah, you round and round it goes, right? Welcome to the retirement tax planning.
So this whole thing is, it's essentially aimed at the middle, the lower and middle income retiree.
Yeah, that's exactly who it's built for. And for a lot of those folks, like I said, it may knock their federal tax bill down to nothing.
Right.
My colleague could genuinely be one of them.
Yeah. So he might actually owe zero. I mean, he might be right.
He might be, but not because Social Security became tax-free, because a deduction he happens to qualify for this year happened to cover it. And this year is the phase I need people to hear.
Because it expires.
2028. Unless Congress extends it, the whole thing sunsets after 28.
And say more about why that window matters, because it expires in 2028. I mean, that sounds kind of far away and a little bit abstract.
Yeah, but you know what? It's not that far away when you're making permanent decisions. If you're timing a Roth conversion or deciding which years to learn hard on it or lean hard on an IRA, this deduction is a temporary tailwind. Plan as if it's here now and gone later, because that's the law as it's written. And building a forever plan on a 4-year rule is how people get blindsided in year 5.
And here's the thing, we're legally required and love saying, none of this is us doing your taxes.
Oh, God, no. That's correct. We're just showing you where the trap doors are. Your actual numbers, your actual returns, that's a conversation with you and your taxpayer. We deal in the map. They deal right in your specific street. Okay, so now here's the part nobody put in the headline. Are you ready? The machine that decides whether your Social Security gets taxed in the first place, untouched, still running, exactly the same as last year. What is it?
This is that, combined income thing.
Yeah, combined income. Some people call it provisional income. And the formula is simpler than it sounds. Take away your adjusted gross income.
That's easy for you to say.
add any tax exempt interest, then add 1/2 of your Social Security benefit.
So half of your Social Security counts against your Social Security. That one alone trips people up.
Yeah, it does. And that combined income number gets measured against 2 thresholds, right? So, Matt, here's what I want you to guess. When do you think those thresholds were last raised?
I mean, I would imagine they adjust these things for inflation, right? Everything else moves. Tax brackets move up every single year.
But guess what? Nope.
What do you mean, nope?
The first threshold, $25,000 for a single person, $32,000 for a couple, has been sitting there, guess what, since 1984.
Oh, my God. Nothing's the same since 1984.
Yeah, the second one hasn't moved since 1993. We did a whole thing on inflation. Go back to those episodes and know the difference. It's crazy.
Yeah. Could you guys live on your 1993 salary right now? I bet you couldn't.
God, no.
And so those numbers have not changed in over 30 years.
Yeah, not a dollar, not for inflation, not for anything. Joke.
And that can't be by accident.
I don't think it isn't. It's when they were written, they were designed to hit only higher income retirees, a small slice at the top. But because the lines never moved and everything else keeps rising, wages, benefit, prices every single year, more ordinary retirees drift over them.
So all these people inflated themselves into these brackets.
They all became wealthy. They don't feel wealthy, but
on paper you are, at least according to the government.
You're a millionaire.
Yeah. So I mean, a threshold that meant wealthy in 1984, it's catching retired school teachers and plumbers and old post office workers and stuff now.
Yeah. Have you seen what a plumber charges now?
I have actually.
I think they're very wealthy. But you know what? That's the quiet part. Nobody raised your taxes. They just froze the line and let inflation just walk you through it.
Yeah.
Like it was nothing.
So is anybody trying to fix it? I mean, are they trying to move those lines and index them to some type of, like CPI inflation metric, like everything else?
Yeah. Look, it gets proposed. It's politically hard because moving those lines up costs Social Security system money and it's going bankrupt. The taxes collected on the benefit actually flows back into the program.
So the tax on your benefit helps fund the benefit.
Which is why some folks call it a tax on a tax.
Right.
And whatever you think of that, My job isn't to argue the policy. My job is just to tell you the line's frozen. You're the one moving, and you should plan like an adult around a rule that's not going to rescue you.
And I want to be the skeptic for a second because somebody's thinking it. Isn't this a little bit of, scaremongering? Plenty of retirees are under those lines and they pay nothing on their benefit.
Good, say it because it's true. You generally below those numbers, this may never touch you. And I'm glad. The scaremongering version would be everybody's getting crushed. That's not what I'm saying. What I'm saying is the line doesn't move and you do. So know where you are standing relative to it. Don't just assume.
Right. So give me a picture of the drift. What does, walked across the line actually look like for, the average, one of the normies out there?
Normies. So picture a retiree in 1985 with a small pension and a Social Security, sitting comfortably under $25,000 combined.
Mm-hmm.
Never paid a dime on the benefit. Now picture that exact same profile today. Pension's bigger in dollar terms. The benefit's bigger in dollar terms because cost of living forced all of it up. Same modest lifestyle. Now, guess what? They're over the line.
They didn't get richer. The number just got dragged up around them.
So they didn't get richer. So it just feels like a tax hike that you never voted for and nobody ever announced it.
And nothing in the new law touched those lines?
Yeah, nothing, because the new deduction is a side door, right? The main formula, the thing that actually decides whether your benefit is taxable, is still setting exactly where it was in 1993. Which brings us to the single most misunderstood number in all of retirement. Are you ready, Matt?
Yeah, the 85%.
The 85%, Matt. When a normal person hears up to 85% of your Social Security can be taxed, what do you think that means?
Honestly, let me be the guy in the audience out there. I hear that and I think the government is taking 85 cents out of every dollar of my check. And I'm getting to keep that 15 that's left over.
And guess what? That's completely wrong.
Okay, good. I'm known to be wrong once a year.
And it's the most common belief, though. It's out there. Almost everybody over 60 is walking around with that exact picture in their head. 85 cents on the dollar goes away. I'm only keeping 15 cents.
So set me straight, slowly, because if I've got it wrong, half the people listening have it wrong the same way.
Yeah, probably more than half. 85% is not a tax rate. It's not how much they take. It's how much of your benefit gets counted as taxable income. That's a completely different thing.
Yeah, walk me all the way through the difference because I don't think anybody's ever actually done that for most folks.
Unless you attended one of our retirement classes.
Exactly, yeah. Or you're working with one of our guys. They do it for everybody.
Yeah, exactly. All right. So say you collect $20,000 a year in Social Security, simplified, round number, at the top tier, up to 85% of it. So 17,000 of that 20,000 gets added to your taxable income, not taken from you, added to the pile that your tax bracket then looks at.
So that 17,000, it's what's exposed. It's not what's actually gone.
Yeah, right. It's exposed. That's the perfect word. Then your ordinary tax bracket, say 10%, then it goes to 12%. Whatever band you're in gets applied to it, not 85%. It's your tax bracket.
So give me the real number on that 17,000. What does the guy actually pay?
Okay, this is where I'm going to frustrate you on purpose, okay? I'm not giving you a hard number on the air because your bracket is yours. Your other income is yours. And the second I throw out a figure, it becomes the gospel for the people it doesn't fit. But directionally, in a low bracket, the actual tax on that benefit is a fraction of it, a fraction. Know where that 85% is.
Yeah. So, basically what you're saying is it's 20,000. They're going to see that 17,000, which is 85%. And then they're going to hit your normal tax bracket.
That's right.
Okay. And that's a wildly different picture than what people are carrying around in their head. I've heard people say they take 85 cents of every one of my dollars.
Yeah,
I mean, people think their Social Security would be 85% higher than what it is.
Guess what? If they did, we probably wouldn't be going bankrupt.
I know, right?
Just giving it all back. Okay, so here's the difference between what they're taking. Most of my check and a portion of my check is now visible to my tax bracket. All right. So one of those is terrifying and false.
Right. Thank God.
And the other is manageable and true.
And where do those tiers actually kick in? You're giving me two sets of numbers now, and I don't want to blur those.
I think that's fair. So look at it this way. 3 zones. Below 25,000 single, 32,000 joint. Generally, none of it's taxed.
Right.
In the middle band, up to half your benefit can be counted. Once you're over 34,000 single, 40,000 joint, now you're in the up to 85%.
So let me lock it in. 25 to 34 single is up to 50% zone. Over 34 is the up to 85 zone. Same shape for couples, just 32 and 44.
Yeah, you're exactly right, Matt. And here's the one that stings the couple. You ready?
Yeah, let me guess. The couple number isn't double the single number.
Yeah, it's not. Why would it be? That'd make too much sense. Single is 25,000. You'd think couple would be 50.
Right, that's fair.
Make more sense.
When is the government ever
But guess
fair?
what it is? It's 32. So 2 retirees who marry can find more of their benefit taxable together than they would have apart. Those lines were never built to be generous to couples. So everyone listening that's over, get a divorce. I'm kidding. Kidding.
It's cheaper to keep her, guys, I promise.
Yeah, right. Then you lose everything. That's a stupid show.
You lowered your tax bill to 0 because now you have no income and no assets. I mean, but that's the kind of thing that most couples only discover after it's already happened to you.
Yep. So, unless somebody tells you first, which is the entire reason this show exists, right?
Yeah. I mean, before we move on, and I want this crystal clear, the 25 and 34,000 lines that tax your benefit and the 75,000 line that phases out the new deduction, those are 2 different lines, 2 different tests.
Yeah, they're completely 2 different tests. And thank you for catching that, because I'm sure people fuse them into one and get hopelessly lost. One tests how much your benefit is taxable. The other decides how much of that new deduction you get to keep. Different thresholds, different math, and I'm sure we're going to hear about it because they're going to get portions of the clip and the shorts and tell us we don't know what we're doing.
Yeah, exactly. I mean, but the same villain shows up in both of those lines, really.
It's income. In both tests, the thing that hurts you is more income landing in the wrong year, which is exactly why the story that we're about to tell you about your buddy is so brutal, right? His one withdrawal walks into both tests at the same time.
Yep. So the game was never make Social Security tax-free forever. The game is knowing which band you're standing in.
Yep. And more than that, knowing that you have a say in which band you're standing in. That right there is the whole rest of the series. Okay, Matt, so let's bring it home. Let's go back to your buddy that's about that RV.
I should text him. He might be sitting down there about to sign some papers.
Yeah, right.
I know I got to call him back, and I like to not ruin his week.
Yeah. Don't buy the RV. Okay, so here's what he's about to do. He heard tax-free, so he's going to pull the big one lump sum out. Let's just simplify it. This is actually, say, $60,000, which is that's a cheap RV.
That's a real small RV.
Or a very small RV. Okay, but he's taking it out of his traditional IRA for that RV in one single shot.
Yeah, one and done, pay cash, drive off the lot. Maybe he's better off buying a TV instead of an RV.
Exactly. Watch what that one withdrawal does, okay? You ready? First, that $60,000, guess what? Counts as ordinary income, and it's taxable all on its own.
Okay, I bet he's expecting that part.
Oh,
Yeah, we hope
maybe.
so. Yeah.
But here's what I don't think he expects. That same 60,000 lands in his combined income, which can drag a chunk of his Social Security up into that taxable zone that we just spent 20 minutes talking about.
Right.
Benefit that might have been setting, safely below that line.
Exactly.
Now he just kicked himself out of it.
Exactly. So the withdrawal gets taxed, then it reaches over and it grabs his Social Security too.
2 hits from one move, baby.
Gosh, man, that's like paying $1 to make 50 cents.
Exactly. And there's the third. Okay, you ready? And this one's almost poetic. Remember that new $6,000 deduction that he's so excited about?
Yeah, the one that made him think he was tax-free in the first place.
Yeah, a withdrawal that big can push his income right over the 75,000 phase-out line. So the very deduction he's celebrating, he could shrink it or lose it entirely. In the act of just spending like he doesn't have to worry about taxes at all anymore.
You always have to worry about taxes, folks.
Yeah, always.
Unless you're living off cash value life insurance, taxes will be part of your life forever.
Mm-hmm.
So the headline that told him to relax, this is the exact thing that makes him pull the trigger that costs him this exact break.
That's the trap. And notice it's not the RV. The RV's fine, but buying that RV, it's doing it blindly. It's doing it in one lump in one tax year because a headline told them the coast is clear. It's all tax-free.
Yeah, and in what order matters here too, doesn't it? Because the IRA isn't his only option for that money.
Yeah, now you're running the show here. The IRA is the most expensive door in the whole house, right?
Mm-hmm.
Tax-wise anyway.
Yeah.
And he's sprinting right straight for it. We see this all the time. He may have cash savings, a brokerage account, maybe a Roth. Each one of those hits that combined income formula differently. And look, some would barely touch it at all, like a Roth, right?
Exactly, yeah. So the guy with choices can buy the exact same RV and control what shows up on the tax return.
The guy with everything in one traditional IRA has what? No moves. That's literally the episode 3, where the money comes from and in what order. But you can see the whole point of the series already, can't you?
Yeah, it was never really a Social Security question.
It was never a Social Security question. It was a coordination question. The retiree who legitimately owes nothing on their benefits, most of them didn't get lucky. They planned every dollar where it was coming from and in what order before they touched a thing.
Yeah, the planning is the most important part, is what I'm getting out of all these podcasts.
Yeah, pretty boring.
And that plan, that's a decision you make well before you retire, not the month before you retire. You start this years and years out. And you don't do this on April 14th either with a shoebox full of receipts.
Yeah, your tax return tells you what already happened, right? A plan that tells you what's about to happen, and only one of those can still be changed.
So, for my buddy, the lesson isn't don't buy it.
Yep. And the lesson is don't buy it blind. Don't buy it all in one tax year and call somebody before you pull the trigger, okay? Same dream, same money, smarter sequence. And that's really the whole ballgame.
Right.
So before you do anything, before you pull a single dollar, you need to know which band you're actually standing in right now.
And that's the thing most people have, genuinely never checked. They're just guessing, or they're trusting their CPA to just handle it all for them,
Yeah, so here's your move today. Guess what? Go to planliferight.com and take the retirement income scorecard. 7 questions, under 3 minutes, I promise.
Yeah, it'll show you in plain English whether your income is set up to keep the IRS out of your Social Security or to walk you right across the frozen lines we spent this whole episode on.
7 questions, under 3 minutes, planliferight.com. Do it before your next withdrawal, not after you've already made your buddy's mistake.
And if you're a financial professional listening to this, if you've got clients about to buy that RV in one lump sum this year,
go to advisorrescue.net. This is exactly the coordination conversation that your clients need before that 2028 window closes. And we're going to show you how we run it at advisorrescue.net. Okay, Matt, next episode, We build the whole formula on the board, line by line.
Nice. And I'm going to show you the exact one that got me the tax-free income that is not tax-free at all. There is a such thing as tax-free income, but not this one. When it comes, not at least tax-free when it comes to your Social Security. Now, if you own municipal bonds, you really need to hear this one.
2 retirees, same exact benefit. One pays nothing, one pays a fortune. Next time, we show you precisely why. Listen, life happens fast.
You want to make sure your income is ready for it.
I'm Kevin Ross.
I'm Matt Floyd.
And this is Playing Life Right.
That's right.